I want to talk, Geoff Yu, about the Thai baht in a 20% depreciation off of the pandemic, and all of that is strong dollar. I get that. And as I mentioned to Dr. Alarian earlier this week, JP Morgan EMFX is basically on a decade-long 48% decline. Powell is central banker to the world. How fragile is Jerome Powell's Bangkok? How fragile is his Jakarta?
Well, unfortunately, all roads lead to Beijing, right? If the borders don't open, there are no Chinese tourists filling the coffers, filling the current account of ASEAN nations of Southeast Asia. It's still going to be a struggle. You know, these countries, and we're anticipating reopening. You just can't turn around an economy like that and from services based into something more self-reliant, self-contained overnight, or even in the course of 2 years. So it's still going to be quite tricky. But a lot are hiking as well. They know they can't take this.
On a relative basis, with the Arthur Burns-like magnitudes of American central banking, witness Bank of Canada this week, how does EM adapt to that besides constructively lifting rates like we saw in the Philippines this week?
Well, there are two ways. One, you've got to move on rates, which has been seen and above and beyond market expectations. But two, you've got to realize, and as the rest of the world has been doing, we are in a world of deglobalization. Your previous supply chains, your previous sources of export revenue, they're going to be there, not going to be there anymore. So invest domestically. The good thing is no one's talking about balance of payments crisis. No one's talking about 1998. There's no dollar leverage globally. Very limited positioning in global markets. Have a credible fiscal and growth strategy. And as that barbell with US equities and fixed income one side and the US dollar cash on the other side, as they seek to fill the middle, I think EM, especially in Asia, will be in a good place to hold that. But it's going to take time.
And Geoff, in the cross currents of EM and the dependency on the dollar, how connected is something like the retail sales figure that we're going to get out in about 10 minutes time, or even the University of Michigan confidence survey, because of how much permission it gives the Fed to raise rates even further than what people are currently expecting?
That's absolutely a nail on the head. It's no longer a story about, US consumers and buy exports from the rest of the world. It's how is this going to push their head? Because if it really pushes the Fed towards a 100 basis point hike, for example, then whatever expectations that any EM central bank had for their next meeting, you add 25 on top of that, you add 50 on top of that. You need to run faster just to stay still. That's the challenge right now. And you're not getting any help, especially in Asia. You're not getting any help from China right now. And some are starting to keel over. Look at Central Eastern Europe, 200 basis points in cuts being priced in now by Poland and Czech Republic, because they need to do so much now. They'll have to cut aggressively later.
Are we going to see 100 basis points? I mean, Geoff, the market pricing has gone up and then back down, now maybe headed back up. But, Neil Kashkari unveiled his dot plot with 3.9% at the end of this year and 4.4% at the end of next year, and he's a dove.
So I think 75 should be the consensus for the time being. Now, here's the thing. We should have markets pricing in 4% terminal or above 4% terminal. So that's key. But pricing in doesn't mean we get there. By virtue of pricing that in, that's a tightening in financial conditions. If that can tame inflation expectations as well, we don't have to get there. But that process needs to run the course, and we're not there yet.